Good morning or good afternoon. My name is Dr. Mike Deliberto. I'm an assistant professor of agricultural economics here at the LSU Ad Center. This morning, I'd like to talk about the crop market outlook and provide a policy update for the 2021-22 marketing year. The economic information contained in this report was compiled between January 20th and January 26th. I've also included links to the various farm management and risk management decision tools that we have available at the Ad Center's website, as well as links to the latest market and policy information. I would also like to thank Mr. Justin Dufour for taking the time to compile this material so that it can reach our various stakeholder groups in a timely and safe manner. Today I'd like to speak a little bit about an election roundup and DC policy updates, but spend a majority of the time talking about the market outlook for cotton, corn, grain sorghum, and soybeans. I'll also provide a short perspective on the Phase 1 trade agreement between the U.S. and China, as well as talk about the farm management and risk management decision tools that we have available for the 2021 crop year, projected cost and returns for various commodities, as well as ARC PLC program election updates for the 2021 crop year. Just to provide a short election roundup, the Senate is split 50-50 for the fourth time in U.S. history. Vice President Harris will give the Democrats a majority in tie-breaking voting decisions. In the House, the party count is 220 Democrats to 212 Republicans. There are 4 seats that remain vacant: the 2nd District of Louisiana, the 5th District of Louisiana, as well as a seat in New Mexico and a seat in Ohio, as those congresswomen have been nominated by President Biden to serve in his cabinet. USDA Secretary nominee is Mr. Tom Vilsack. President Biden nominated this individual to run USDA. That's a familiar name in agricultural policy circles. He served in that capacity for 8 years under the Obama administration. The House Agriculture Committee is going to see new leadership. The former Ag Committee Chairman, Mr. Colin Peterson, a Democrat from Minnesota, lost his re-election bid in the November elections. The incoming chairman of the House Ag Committee is Mr. David Scott, a Democrat from Georgia. Like Mr. Peterson, he is a member of the Blue Dog Coalition, which is seen as having moderate Democratic views on policy. Mr. Glenn Thompson from Pennsylvania will be the ranking Republican in the House Ag Committee. On the Senate side, Debbie Stabenow will be chairwoman of the committee, with Mr. John Bozeman from Arkansas being the ranking Republican member on that committee. Ms. Stabenow was a lone holdover from the 2018 Farm Bill negotiations. There are undoubtedly a lot of things to watch in Washington as the days, the months progress. Party control and agenda, no doubt, is at the front of many people's minds right now. Plans for fiscal stimulus to boost the economy, thoughts that is that going to lead to higher inflation, consequences that may have from a macroeconomic perspective are real. But I think as it pertains to agriculture, the approach to drafting a new farm bill, not only the Biden administration, but also Democratic leadership, as markup committees are being formed, as input is being received. What is that approach to drafting that new farm bill going to look like? Where's the emphasis going to be placed on different issues? We have this regardless of party control, and really every time a farm bill comes up. But I think certainly one thing is the White House approach to trade aid and energy policy. And with energy policy, I'm also speaking probably toward climate change. The Green New Deal has gotten a lot of popular press attention. The Trump administration, from a trade perspective, had preferred direct assistance made to growers. How will the Biden administration view trade aid? Will that administration seek to renegotiate these trade deals, or will he rely more on his cabinet for input? That remains to be seen, but it's something those in the agricultural policy world are undoubtedly watching. So that was agricultural policy update in one slide. I hope everybody just appreciates how brief I was on that. That'd be a whole other presentation in itself. I want to talk about the cotton market outlook. This slide shows cotton production in 2020 as compared to previous years. Cotton production in 2020 was lowered month over month by 1 million bales to 14.95 million in the recent supply and use estimates that USDA published on January 12th. And that month-over-month reduction really stems from a major decline in Texas. Texas was responsible for about a 500,000 bale decline. Production is down nearly 25% from 2019 level, mainly on a reduction in harvested acres. I'll call your attention to that blue bar. That is USDA's October 9th projection of where they think 2021 plantings for cotton will be. They project plantings at 11.2 million acres, with 9.5 million acres being harvested. Average yield per acre estimated at 850 pounds, and collectively that adds up to about a 16.9 million bale crop, and if realized, that would be a 13% increase year over year. Again, those estimates came out back in October, before we had this run up in the grain market and cotton market too, in a sense, which I'll talk about later. The National Cotton Council will release their planting intentions from some survey work they've done in February. Cotton grower seems to think that there's going to be about 12 million planted acres of cotton in the U.S. next year as well, but time will tell. So much attention is these bearish and bullish factors that are really weighing on the cotton market right now. Or in other words, what are the implications for the direction? Is the cotton market going to go the way of the bull, or are there bearish headwinds and factors that the market just can't ignore? And I think given the late and somewhat rather large cuts that USDA made to the January balance sheet of cotton, some of these factors I think warrant a little bit further of a dive into some of their economic fundamentals and in what they present to the market. I've listed the bullish factors and the bearish factors. I've gone into significantly more detail in my most recent January market letter, but I want to talk about just a few of these. Tightening in the U.S. balance sheet. On the next slide, we'll talk about the supply and use fundamentals and the categorical changes that USDA has made, not only from production but also use. Global inventories inside China are low, but I think a lot of thing that's gotten a lot of attention over the past few weeks has been the spec money flow. Generally speaking, as long positions increase in the market, prices tend to increase. As the trade goes short in the market, as these prices increase, they're selling into the price rally. A weak U.S. dollar can also be supportive or a bullish factor for cotton and other commodities that trade at an inverse to the value of our currency. Weather, drought monitor, drought is a concern, especially in the southwestern region of the U.S. That could provide a little bit more long-term support in the market. And also a recovery to, I wouldn't say pre-COVID demand levels, but certainly a return to demand and economic growth are also important factors to support the cotton market. The biggest headwind right now, COVID, the global balance sheet in cotton, but synthetic fiber prices. Chinese polyester prices remain cheap as the cotton price inside of China, outside of China continues to increase. And as cotton prices increase, producers of cotton and textiles are going to switch to polyester or synthetic fibers. This is a fundamental snapshot of the January balance sheet for cotton. I've compared the 2020 marketing year, that's in that light blue bar, to the previous year of 2019-2020. Before we really start diving into some of these numbers, there have been a lot of discussions as to whether the cotton fundamentals that are in play right now really justify why we're seeing prices as high as we are, much less as December cotton approaches 80 cents. World demand is increasing, but more importantly, world production is headed lower. And world carryover, or our ending stocks on the global level, are also declining. So I think the recipe there, to quote Dr. O.A. Cleveland, the recipe's there for higher prices. But when you start to look at the balance sheet and the fundamental changes that we're seeing year over year, production, I've indicated with that red circle, is down about 25% year over year. Reduction in cotton plantings last year, some weather disruptions in the southeast and the mid-south region as well. So we do see total supply as a consequence of lower production being down 10%. And that was contradictory to the fact that we've had a major increase in beginning stocks. Those 7.25 million bales of cotton that were on the books and on the market last year that we carried over were really more than offset by that big decline that we had in production. The domestic use, we do see exports, 15.25 million bales of cotton for 2020, and export sales continue to be robust. There's been some speculation that, will USDA increase its export estimates? Some people think that that number could go as high as 15.5 to maybe even 16 million bales. Vietnam, Pakistan, Turkey, Bangladesh, and China are principal buyers of our cotton right now. So even though we have a smaller crop, you see almost an identical level of exports year over year. Total use is down a little bit, mainly as a result of that smaller crop, but the ending stocks and stocks to use ratio are moving down, and those act inverse to price. As those ending stocks and stocks to use ratio become lower, it can be seen as being supportive on prices. But that ending stock level of 4.6 million bales, and I want to put that just in a little bit of context, they were down really an unbelievable 1 million bales from the December estimate. So USDA made a rather significant and a rather late and large reduction to those ending stocks. And I think that's why you're seeing those prices for cotton being justified as December, approaches that 78, 79, 80 cent level there. Certainly the forecast for improved economic activity associated with more consumer spending, the proposed stimulus package, do allow for more expanded growth than maybe what was traditionally or normally expected. And as such, USDA has taken the season average farm price for Upland cotton. They've taken it up 3 cents over last month to 68 cents a pound. That's compared to about 60 cents that we saw last year. But one thing when you look at the fundamentals here on the balance sheet, I think the market saw this coming, and I think it already factored in these changes. Well over a month, you can make the argument that the market started factoring some of these changes with reduction in available supply, as well as increase in exports and the pace of export sales for almost 2 months, despite USDA being, late to realize that there was a need for adjustment there. From a technical standpoint in the market, I don't have a slide on this, but the CFTC Commitment of Traders report, it showed that managed money traders were net sellers of about 1,800 contracts for the week ending January 19th, and that reduced their net long position to about 67,000 contracts, and trend following traders have been net long for about 9 months now, and that has an impact on prices. And when we look at some of the futures movement here in a little bit, I'll go into that in a little bit more detail. This slide shows U.S. cotton exports to all countries for 2020-2021. This was information released by USDA. It was accessed on January 22nd, but it does present export data from the 14th of this month. Led by U.S. exports, world trade in cotton continues to expand. China really has replaced Vietnam and Turkey as the principal market for U.S. cotton. And you can see our current year sales in the red line there are over the previous year in blue and well over the 5-year average in green. This next slide focuses specifically on U.S. cotton exports to China. If the U.S. holds its current policy position on agricultural trade with China, China could import nearly 5 million bales of cotton in the coming season. The major caveat to that is it's going to depend on whether the U.S. enforces that Phase 1 trade agreement with China. What will that Biden administration What will their stance on China be as compared to the Trump administration? But China's demand for cotton, and you can see in that red line in the current marketing year, has been led by state reserves and state-owned enterprises, which have likely accounted for more than 3/4 of total imports of U.S. cotton thus far in the marketing year. Instead of sourcing from Brazil and India, U.S. sales and shipments to China through December exceeded the previous year by more than 2 million bales. I think that number is 2.3 million bales to be exact. So strong sales to China. This slide, again, kind of piggybacks on the previous slide. Strong exports are buoyed by China. Record shipments from the U.S. of cotton into China from August to December. Record U.S. shipments are strong supporters of cotton, and that maybe that export forecast should be raised. And I think this was maybe an underlying factor to that balance sheet when we had that discussion about U.S. cotton exports maybe being raised to 15.5, 15.8, 16 million bales. China's accounted for almost half of U.S. exports in the first 5 months. That country's total import forecast of 10.5 million bales is the highest that China's seen in almost 7 years. Moreover, China's consumption is expected to recover 5.5 million bales from last year and reach 38.5 million bales. And China accounts for about 1/3 of global cotton use. But one thing to keep in mind, world garment and apparel manufacturers and several international brand name retailers have faced pressure from Washington's focus on human rights abuses by the Asian nation. The U.S. has now received support from Great Britain, Australia, and other European Union countries in banning cotton goods coming from that Xinjiang region of China, which is China's primary cotton producing region, for entering their respective countries. This graph shows Chinese futures price, the A-index, and U.S. ICE futures from New York. This was through January 14th. Chinese futures prices are higher than world cotton prices, mainly in part from policy distortions. Their support price in country is near $1.05 per pound. So really it's cheaper for Chinese mills to import U.S. cotton rather than buy local Chinese cotton. Again, those labor rights issues have forced China to import more cotton to be used for manufactured goods that are going to be exported to the European Union, going to be exported to the U.S. But higher Chinese prices are causing support for U.S. cotton on the A-index, which is that red line. Chinese futures price being that blue line there. Cotton prices increased, exports are increased. Cotton contracts on the ICE board in New York, established life highs. And I think that's noted in the stronger Chinese market has really followed suit and followed through into other markets. But fundamentally, global cotton market, what size reserves are China, what are they going to maintain long term? The size of those state reserves, what's that going to be? What's China's policy for rotating that inventory going to look like? Will China have major purchases for that reserve that we saw in 2020? Will those purchases continue in 2021? And are they stockpiling for a future shortage right now? So these questions are hard to answer, difficult to answer, but I think those are looming questions that not only is being considered by the market, but also something that we're going to see appear in the futures market. This slide is compliments of Pro Farmer. In the absence of me being in Mansura at the Extension office today, I normally wouldn't put this much text on a future slide, but I thought it did provide some good context there on the March contract. But from the 22nd, from last week when the markets closed, fundamentally, futures in cotton extended their 9-month rally, and that coincides with those managed money positions taking that long position over the past 9 months. So we see a little correlation right there with that rally being extended to the highest level that we've seen in the cotton market since September of 2018 on tightening supplies, and speculation that Chinese demand for U.S. cotton is going to continue to advance, really, amid cries of, bans on Chinese textile imports from that Xinjiang province. But the strength of this contract is influenced by good export demand, surging Chinese cotton prices, having some follow through on the A index and essentially those ICE futures, volatile grain markets right now, and we're also seeing supportive factors outside of the U.S. commodity market, specifically the financials, the declining U.S. dollar, and also that trend following speculation. December contracts for cotton were almost 79 cents, I think 78.88 cents as I do this presentation on the morning of the 27th. Shifting gears, talking about U.S. corn production. This slide just provides a historical comparison. U.S. corn production in 2020 is estimated at 14.18 billion bushels. That's down 324 million bushels month over month from lower yields and a slight reduction in harvested acres. USDA took the expected average yield per acre for the U.S. from 175.8 bushels. They took that number down to 172 bushels in their latest January WASDE report. We've also seen lower state estimated yields and production from states like Minnesota, Illinois, and Iowa. You could see USDA for 2021, that early October estimate, that blue line on the far right-hand side of that chart. They project 2021 corn production at about 14.89 billion bushels. That's on 90 million planted acres of corn, with 82.5 of those acres being harvested. And they're using an average yield of 180.5 bushels an acre. And again, that's USDA utilizing trend level yield. So I think you can make the sense that that would rely or make the assumption of normal weather conditions and crop development. But nevertheless, USDA from that October estimate does see U.S. corn production next year increasing about 5%. Fundamentally, this is the U.S. January WASDE report. Lower supplies are projected, and that substantially tightened the market outlook for corn. We saw lowering use across all levels. We saw raises in projected prices, and I think that those two bullet points can probably summarize the numerical estimates contained in this table. But I do want to start out with the 2021 marketing year. We did see beginning stocks were lowered. Beginning stocks were lowered by an additional 76 million bushels to about 1.9 billion bushels in the latest report. And that change was due to revisions made by USDA in their grain stocks report. We see production being up year over year. Total supply is up slightly. But when you transition down and get into the feed, the industrial, the ethanol use, the export number, the tighter supplies have resulted in a reduction to individual uses for corn, specifically for fuel use. You could see feed use is down about 4% year over year. We do see slight increases in that food, seed, and industrial use category, slightly about 1.5%. But the biggest takeaway from this on the use side is the rise, or the significant rise, in corn exports, and that's being led by China. 43% over where we were from the previous year. So we see total use, being up about 4.4%, and that compares to total supply being up only about 1.5%. So that higher level of disappearance than previously estimated is providing support for the market, is contributing to that tightness that we see in the corn market. Our ending stocks are down 19% year over year. We've gone from 1.9 billion to about 1.5 billion. That stocks to use ratio is getting tighter, 13.7 down to 10.6%. And the result was we saw that increase in season average farm price. USDA took the price of corn up in January to $4.20 a bushel, and that compares to $3.56 that we saw last year. But I do want to spend just a quick second or two talking about the total shares of U.S. corn use. So much attention has been given to the export market for corn, but when you look at total corn use of 14.5 billion bushels, exports only account for about 17% of total corn use. 39% is feed and residual use, 44% is food, seed, and industrial use. Ethanol is contained in that category, so if you want to do a further breakout, ethanol accounts for about 35% of disappearance in the U.S. corn market there. So I say that as a cautionary note that while exports, increases in exports are important, it's only 17% of total disappearance. Corn used for ethanol is reduced month over month from that December estimate. It's totaling about 4.95 billion bushels. Quarterly use is slightly lower than the same period that we had last year. I think we're trailing just under about 3% from where we were. And those are reflective in changes in transportation fuel demand and really changes in driving patterns from lockdowns, shutdowns, COVID-19. And you can see the red line in ethanol production again just shows where we were relative to that major drop-off that we had in 1920 in March with the onset of this COVID-19 pandemic. Recovery in the ethanol market is happening, but I think it's going to be dependent long-term on policies put in forth by the government in terms of reopening the economy and things of that nature. Corn exports, just talking a little bit more in detail, I wanted to highlight the September to November portion of the marketing years and just taking that snapshot of a marketing year and going back about 2 decades. Despite tighter domestic supplies of corn in the U.S., strong global demand for feed grains, particularly from China, paired with the weather-affected summer crops in Eastern Europe like Ukraine and South America, have resulted in strong demand internationally for U.S. corn and feed grains. And you can just see in 2020 that orange portion of the bar is early sales to China. And China's really been absent from the U.S. corn export market for some time. We still see good sales to traditional markets like Japan and Mexico year after year. When you look at this representation in terms of U.S. corn exports, we are higher than where we were the previous year, pretty significant amount, but we are tracking over that 5-year average. And through the first 3 months of the marketing year, the U.S. has exported about 4.46 million bushels of corn. Thus far in the marketing year, total foreign shipments have not reflected that record pace outside of China. So I think while China's attention, they're buying U.S. corn as a positive for the market, it's important that we look at markets like Mexico, Japan, certain markets in the Middle East to view overall export increases. This slide, again, focuses specifically on China. The share of shipments to China, however, that's been remarkable. That's been on record pace, both in terms of the exports that are currently being reported by the Census Bureau through the first 3 months of the marketing year, and really total commitments being reported by USDA. But the increase of China's presence in 2021 in our export market has come at the expense of other smaller, maybe non-traditional markets. And I think the higher prices of corn may limit consumptions and imports, for that matter, for countries such as Mexico, Malaysia, Vietnam, Chile, Colombia, the Dominican Republic, Saudi Arabia, really traditional but smaller markets that have sourced U.S. as well as Argentine corn. But I think in order to reach the current record projection, we're going to need to see that strong pace of shipments is going to need to occur throughout all the markets from a cumulative effect the remainder of the marketing year. This graph shows corn export bids from Argentina, Brazil, the U.S., and the Black Sea region. And I think strong prices that we're seeing now could curb that import growth outside of China, those countries that are sensitive to rising feed costs. Since December, corn export bids are higher across the board for all countries, driven by really rising soybean prices, and supply, weather-related concerns in South America has really followed through, kind of came into the corn market and stimulated prices. Cash prices for corn have steadily increased really over the summer. If you go back on that chart, look to where we were in August when we started to see that run up in export bids. Diminished production was seen for Ukraine and Russia, as well as that increasing demand for China was starting to materialize on the global corn market. So the price effect that the tightness in the domestic market, the stimulated corn exports have really given us. This graph from USDA charts the monthly corn prices received by farmers over the previous marketing year. That gray line is 2020. Through November, as reported by USDA NASS, the farm price received for corn has increased steeply really in each consecutive month from September to October to November. And that price level remains below $4, however, because I think it's likely that much of the corn marketing thus far was sold prior to those significant increases in cash and futures prices that we're seeing now. This graph just shows the cash corn prices that are coming out of the Louisiana Gulf. I put the previous two marketing years down at 429 and 404, but really since the summer, since August, right? You could see those corn export bids on the previous couple graphs, and you can look at what the September, the October, the November, and the December bid price out of the Gulf has: 423, 440, 474, 485, 506 a bushel, reflecting that strength in strong exports and the effect that can have in the local markets. This graph again is from the end of last week. This is a December corn futures. Again, I put the resistance levels there on the chart, but fundamentally, we did see a slide in prices, the week of January the 18th, and that may have confirmed that the market did see some short-term peaks put in place. I think action over the next 2 weeks, some thought that was going to be choppy. We are seeing a recovery on some technical buying, and I'll get into that in a minute. But it's really being dependent upon stronger exports that we see in the market. Fears of big crop losses in Brazil have eased somewhat with every weather report that comes out of South America. Widespread rains have been beneficial, but I think arguably that country is going to need to see more rainfall and moisture. Corn use for ethanol, again, that's the big concern right now. That's tied to future government biofuel policy. It's tied to rising COVID infection numbers, restricted travel restrictions, and really the curbing of gasoline usage that we're seeing now. Here's the Commitment of Traders report for corn. This report shows large specs were net sellers of about 20,000 contracts of corn futures and options in the week ending. They liquidated about 35,000 long positions, but overall they still hold a large long position. The commercials were net buyers of just under about 15,000 contracts, and they still hold a massive net short position. So, early on, cotton futures plummeted 17 to 24 cents when I started putting some of this information together earlier this week on January the 25th. Under pressure from a huge wave of this spec long liquidation that we saw in the market, and really the selling was really being driven by technical weakness and sharp losses in soybean futures. But what a difference a day makes. Going into January 26th, which was Tuesday, we saw these bull markets making corrections, not only in corn but also in soybeans. And I've just put some bullet points here. We saw the fund liquidation and profit takings subside from last week. We saw the grain markets recover. But we also need to remember bull markets can and oftentimes will have large corrections in them. We're likely to see big ranges, I think, for corn and soybeans. Again, ethanol production numbers, export sales, weather conditions in South America, but also what is that acreage going to look like of U.S. plantings in 2021. The market rallies, I think, could be restrained by stabilizing or rising crop estimates coming out of South America. But, overall, bullish sentiment remains intact from, again, the tightening U.S. supplies, tightening global supplies, and I think that's been factored into the price highs that we're seeing right now. It was recently announced yesterday by USDA China bought 53 million bushels of corn and 200 million gallons of ethanol. And that climbed corn prices double digits in the futures markets. That ethanol purchase would be the most ethanol China's ever bought in a year, and China says it's going to do that in the first 6 months of 2021. Significant purchase, I think, would be an understatement for this graph right here, but ethanol still faces about a 50% tariff going in country, so that's going to be interesting to see, but nevertheless, this is providing support not only in the export market for corn, but in that total use, long-term strength of where the futures market could go in corn. Originally, this slide was a lot more easier to read when I looked at the technical sell-off that happened on Monday, the 25th, but then when the market recovered on the 26th, when that technical selling subsided, and that purple box there is really the December 21 corn, 429 to 438 just in a day swing. So again, we are seeing some volatility in the commodity markets right now as questions of, supply, export competition, weather reports, spec money coming into these markets. As more information is known, as we see changes in one or a combining of those factors, the effect that it can have on prices. And I put that here to illustrate this point. I'll talk about it later when we talk about new crop pricing. When we look at these numbers, how does it relate to my marketing plan for a commodity? What is my cost of production? What's my break even? What selling targets do I have for, say, December corn? I wanted to put this in. This is a private trade estimates. You can see where I got it from, source there, with bullish and bearish scenarios for corn acreage. But one thing I do want to point out on this, bullish scenario, could we have, 90 million, 91 million acres of corn planted? Could we have as much as 93 million acres of corn planted? Ethanol use, how fast does ethanol recover? The export market, traditionally would exports be 2.4 billion bushels or 2.6 billion bushels. But if I draw your attention to that last line on that table, you'll see, corn prices, bullish scenario 420 to 470, bearish scenario 380 to 420. Higher than where we've been, but I think it illustrates that continual tightening in the corn market as well. Transitioning into the grain sorghum portion of this presentation, this is the supply and use estimates from the January WASDE report. Grain sorghum crop is expected to be about 373 million bushels. That's up about 2 million bushels over last month projected. Planted area was at 5.9 million acres, and average U.S. yield was slightly over 73 bushels an acre, and that's what's led to about that 9.4% increase in production. We saw a tightening in the market. Beginning stocks were down over 50% from where they were. That leads us to some supply tightness that we're seeing there. On the use side, residual use is down. Exports are up 42%. Other uses were lowered slightly. That's mainly based on lower grain sorghum use for ethanol. Total use is consistent. When you combine that with a smaller crop, you're going to see a tightening of ending stocks. You're going to see a tightness in the stocks to use ratio there. Exports are at 290 million bushels. If realized, that would be the largest amount of sorghum we've exported since 2015. Ending stocks are projected to decrease. USDA's taken that farm average price of $4.70 a bushel. They've taken that up a whopping 30 cents per bushel over the 440 that we saw in the December estimate, in reference to really the tighter cash market and higher cash market prices right now. Higher market prices combined with the reduced demand for transportation and fuels really, again, resulted for that minimal grain sorghum used in ethanol production during the first 3 months. So when you look at that industrial use category of 75 million bushels going to 15 million bushels, that 80% really jumps off the page at you, but really just driven by higher prices and uncertain travel use and government policy. That's where we see the reduction in sorghum that's being used for ethanol production. This is U.S. sorghum exports to China. I want to talk about that market specifically. Current year in the red line, well over the previous year, well over the 5-year average. Foreign demand has been really strong for sorghum. However, as more sorghum is projected to be exported in 2021 to markets where demand for institutional feed is robust. So I think markets like China, the recovering of inventory and swine herds certainly bode well for the sorghum market. We've seen substantial export sales to China for some time now. As long as those sales remain strong, I think the future for exports, the future for sorghum prices relative to the tightness of the market bodes well for prices. Monthly sorghum prices, that's that gray line in the graph for 2020. Monthly sorghum prices received have been steadily increased really over the past 3 months, similar to what we see in the corn market, significantly higher in recent months than really any point over the past 5-year period. We're essentially going off the chart right there, north of $4.60 a bushel in the cash market as reported by USDA NASS. Soybean production. This graph talks again about the historical soybean production here in the U.S. Soybean production is forecasted to be about 17% higher than last year, 4.1 billion bushels compared to about 3.5 billion bushels, and that's led by an increase in harvested areas, about 7.4 million acres harvested more now than we had in 2019. However, yield was taken from 47.4 to 50.2, but planted acres were a record of 4.5 million last year. The prevent plant coming out of the Red River Valley of Minnesota, South Dakota, as well as the Mississippi River Delta region really brought that total production number in 1920 down to about 3.5 billion. You know, some in the trade think that we could have as many as 90 million acres planted next year to soybeans. Certainly, if we were to revisit what that would look like to corn plantings, that would favor maybe more of a bullish outlook with what the trade has for corn. The blue bar right there is the early October projections of USDA. They've got 89 million acres planted, 88.2 million acres harvested. Yield per acre of 50.6 bushels per acre, and that would be about a 7% year-over-year increase in production. So what does this look like on the balance sheet? Production in 2020 is down 35 million bushels from that December forecast, and that stems from a reduction in the average yield. With record first quarter demand for U.S. soybeans, USDA increased the crush number to an all-time high. So we see beginning stocks being lower. We've had fewer carry-in year over year, and we're starting to see that be really a big factor in itself under the market. If we were to expand this and go back to 2017, 2018, 18, 19 marketing year, that ending stocks level was 600, 700, 800, even maybe 900 million bushels per acre. So if we're starting the carryover or the new marketing year with a reduction, it does speak to the tightening of a market. And when we have 2 consecutive years of this tightening, it can really add to impact what that supply and use balance sheet looks like. So we see beginning stocks being down 42%. We do see production raised mainly by, you know, that the preventing plantings that we had in 2019, being able to get planted this year. Production was up a little bit. Crushings were up, even though 1.6%. That 2 billion bushel, that 2.2 million number is a record. The brisk rate of soybean processing is encouraged by these escalating values for soybean meal, soybean oil, certainly supporting the market. Export sales to China overwhelmingly supporting the export number being up almost 33%, 1.6 billion to 2.2 billion bushels. We see seed residual use up. So we're seeing a big increase in soybean use year over yield. 3.9 billion to 4.5 billion. That's a 15% increase year over year. We see our ending stocks going down whopping 73% from 525 million bushels to 140 million bushels. And if you break that 140 million bushels down, you survey people in the trade, a lot feel that that's kind of the minimum that we need in the pipeline to really have stable long-term supplies of beans for processing and exports. But stocks to use ratio going down 13.3 down to 3%, a big 10% drop in that ratio alone. And that's why we're seeing that price climb season average farm-wise from 8.57 last year to 11.15 this year. Last month, USDA had a 10.55 per bushel price. So again, the lowest ending stocks we've seen since 2013, when ending stocks were 92 million bushels. How does that coincide with the futures market, you may wonder? That's when beans peaked at over $15 a bushel, close to $16 a bushel. So tightening in the soybean market. I thought this graph from USDA was interesting. Not only was it in LSU colors, but it brings up an increasing point. We're seeing increases in domestic use and in exports the previous two marketing years, when we've actually seen production decline. And again, we've talked about production being down from a reduction in yield, but the larger soybean harvest is really being offset by those lower beginning stocks that we have every year. So we're really exceeding our production gains based on strong use from the crush and strong exports in the global oilseed market. This is just an illustration really of the monthly changes that USDA has incorporated into their balance sheet. May 2020 was the first month that USDA actually puts out a new estimate. So what they did was, you see production and ending stocks here. Weather events in August and September, increased usage, increased exports have taken that ending stock number, or that purple line, down to the lowest number we've seen nearly in 7 years. So these month-to-month revisions that USDA is incorporating into their outlook has certainly bode well for prices. This crush graph right here, we've had the second highest domestic crush. That's a really strong pace to start 2020. December soybean meal prices reached their highest value in central Illinois since 2014. That robust market led USDA to raise its forecast of average meal price. Rising market prices are a response to swiftly tightening soybean supplies and a brighter outlook for meal exports. Nevertheless, gains by processors may diminish as they may become more constrained by surges in the cost of soybeans. So these crush numbers are going to be something to watch as we move forward. I put two graphs of soybean exports here. Soybean exports have this season have swelled by 80% compared to the first quarter in 2019. That first graph on your top left is accumulated soybean exports to all partners. The bottom graph is China only. Exports are greater than 2 years ago to China, particularly pre-trade dispute. So the U.S., only 3.5 months into this marketing year through December, our export sales were 90% of USDA's annual estimates. And that's, granted the marketing year is front-loaded with sales from September to February. Most of that business is going to switch to South America as they start to ramp up their harvest. So that's going to be something to watch as we talk about the pace of sales. Weekly export inspections are another indicator to the health of the climate of U.S. soybean exports. Export inspections were strong. Soybeans were really higher than most in the trade expected. U.S. has already shipped about 1.6 billion bushels of soybeans this year, so that's 70% of our target. One thing to watch is the Brazilian soybean export number. Their January estimate was lower than where a lot of folks thought it was going to be early on. Rains have slowed harvest, reducing exports in the near term this year. But again, their soybean exports really peak in February, March, April, and May. So this is going to be something that the market is really intently going to watch, and the effect that it can have on soybean prices. Prospects for less than a 2-week year-end supply of soybeans are really rallying the market right now. Highest level of prices we've seen since 2013. This is just a historical average season average farm price received by producers, it's at $11.15 per bushel, but the monthly number since mid-August, cash soybean prices are up almost 50% on good China demand, okay, based on rebounding feed use and tightening U.S. supplies. The November estimate monthly price was $10.30 on the cash market nationwide. Soybean futures, when you look at where the week ended last week on the 22nd, the market fell. It was the biggest percent daily drop since August. Some of the market think that with that drop on the November contract, was soybeans, was that V put in? Has the markets made its top? Markets will often make a V-shaped pattern in the chart. There's certainly plenty of uncertainty ahead as buyers are going to get back into this market. Support levels, resistance levels being held is going to be a major factor for, I think, the long-term health of staying, above $11. Is that, initial support? Maybe is that down to $10.60 a bushel? But when you look at where prices closed, futures retreated after prices rallied above $14 for the first time. Timely rains in South America, that triggered a lot of profit taking in the soybean market. While more rain is needed, the reduced weather threat, I think it curbed some of that spec enthusiasm that we saw that was really driving that almost vertical rally that we did see in the market. Large new soybean sales are encouraging on the market, tightening ending stocks. That means the market's going to maintain those risk premiums to ensure or entice more soybean acres as that February crop insurance discovery period approaches. Where are those revenues guarantees going to be set? It does appear to be favorable. That may limit the downside, but I think stronger demand is going to be what we need to continue these rallies. Soybean futures were down, and that was basically spec long liquidations and some technical sellings we saw in the market. But I think there's still room for further technical driven sales and liquidation, maybe near term. But I think, it seems clear that from the futures price action that the bullish news, hasn't been factored into the market for now. That doesn't mean that the prices are going to fall apart, but I think right now you're seeing that downside risk in the market from that previous slide with that V shape maybe tend to indicate that support level may be at that 10.60 a bushel number. Similar to corn, this just really, what difference a day makes. November beans at 11.06 up to 11.34. Again, marketing plan, identifying targets, knowing cost of break-even production for all your crops will certainly help in your marketing plan, making sure you reach those targets you need to be. Soybean balance sheet, private trade estimates here, compliments of Richard Brock here. Bullish and bearish scenarios that I've kind of presented here. Bullish scenario I think would be 89 million bushel planted acres. Bullish would be over 90. But you can see prices are still higher than where they were last year. On a bullish scenario, $13 a bushel. Bearish scenario, maybe $10 a bushel. The biggest thing, stocks to use ratio and ending stocks are still going to be historically lower than where they were. Solid global demand scenario for grains and oilseeds hasn't changed in the market. African swine fever, recovery in China, is that going to curb demand? Right now it doesn't look like it is. Weather outlook in South America, what's that going to do? Truck drivers in Brazil are still pushing for nationwide strikes beginning February 1st. So the effects that this can have in the market, and it can appear in futures, again, are something to watch with where the market goes or which direction it takes. Phase 1 trade deal, very briefly, it commits China to importing about $36.5 billion in U.S. agricultural goods in the calendar year 2020. This graph, compliments of the American Farm Bureau, shows Chinese customs data for imports of Phase 1 for ag products during 2020 are $23.8 billion. That's still 35% below the goal of where they need to be, but it is up 65% year over year. Beijing purchased about 58% of exports that are going to be expected under this from an agricultural standpoint. As we enter year number 2 of this trade deal, I think from a policy perspective, that Biden administration, are they going to try to renegotiate this deal? I know Beijing is pressing for a meeting of top diplomats and senior aides. But China's soybeans from the U.S. rose by 53% year over year, so that does bode well for exports, but it is short of where we need to meet our trade goal. But China's appetite for grain imports is real. When you look at where we are in 2020, that's led by corn, it's led by sorghum. We've also seen increases in wheat and barley. Corn, wheat, they're under a TRQ system as China raises their TRQ for imports. That certainly helps. But one notable concern right now is China's reported its first outbreak of the swine fever in 3 months, sought to be from illegal transportation. But China's hog herd grew by about 31% year over year, and Reuters reported this at the end of last week on the 21st of January. So if we take that market outlook, and I know that was maybe perhaps too much information, I do apologize. Thank you all for still listening to this. But what we do every year is project our commodity cost and returns and do some break-even analysis that are in our enterprise budgets. And you can see I've broken down corn, cotton, sorghum, rice, sorghum, and soybeans. My apologies for where sorghum was duplicated twice in this. But this speaks to where nearby crop futures are. This was in nearbys about a week ago on the December contracts for corn and cotton, the September contracts for rice, and the November contract for beans. I'll take corn first. We estimate our total variable cost on corn to be about $492 an acre. With a projected yield of about 180 bushels an acre, a grower is going to need to see about $2.73 per bushel just to cover the variable cost at that yield level, or $3.31 a bushel to cover their total cost of about $5.95 an acre. These are going to be dependent upon total cost of production and your projected yield. And we do have software that will allow growers to go in, calculate rental rates, because these numbers appear for an owner-operator budget, but it will indicate the margin or the profitability or the competability of these different crops. Right now, corn, cotton, soybeans, especially rice, we're in a different spot than where we were last year for the better, where new crop futures are and where farm income is projected to go. So right now, the outlook is pretty favorable compared to where we were last year. Pre-planting price ratios, I think this is going to get a lot of attention going forward. I've taken the big 3 crops in the Mid-South, cotton, corn, and soybeans. I've looked at the December price averages. I've kind of gone back about 5 years and really looked at new crop ratios on corn, cotton to corn, cotton to soybeans, corn to soybeans. And right now, soybeans still has the favorability. Corn over cotton right now, but cotton's making up some ground right now, so it'll be really interesting to see where these prices go, especially as planting season approaches. Real quick, that corn-soybean planting ratio, usually anything over about 2.37, 2.4, does start to favor soybeans. What I've done over the next couple slides is breaking some of these rental arrangements down, breaking some of these profitability down. What I've done is I've taken corn production at $495 an acre, and I've assumed that the grower is going to is on a 20% share rent. And I've varied the corn price from $305 to $425, and I've varied yield from $180 to $205. And what you can see is on that 80% share of the grower, less his production cost, this is where 180 corn or 180 bushel corn looks like in terms of returns above variable cost to the grower. So at 180 bushels, really anything over 350 is going to guarantee positive economic returns. Again, this is sensitive on your expected prices, your expected yield, your expected production cost, but this is just kind of a snapshot of the impact that price, yield, and rental arrangements can have on grower profitability of corn. I've taken soybeans varied price and varied yield, looked at about $373 per acre. I've taken a 20% share rent out, so we have 80% of that crop going back to the grower, and really at $10.50 above a $10.50 price is going to provide positive economic returns to the grower. For sorghum as well, it's going to take, at 420 north of 80 bushels per acre, and at about $263 an acre on a 20% share rent. Cotton, a little bit different story. Cotton is not as competitive compared to the grain prices now, but let's look at 77-cent cotton on 1,000 pounds is what you're going to need to break even at $615 cost per acre on an 80% grower share. And I know all of that varies. Those are just kind of point-in-time estimates of grower profitability, the impact that prices and yield can have on economic returns. At the Ad Center, Mr. Brian Hilbin and myself have developed comparison tools that will allow growers to look at corn, and in this case sorghum. You can enter your variable cost of production, your expected yield, your share rent. Is it a percent? Is it a cash basis? For corn and soybeans, and you could set prices, and this graph in yellow will tell you at what prices would corn outcompete sorghum. We've done the same thing for corn compared to soybeans as well. We're letting growers go in, specify their own price and yield expectations, their own production cost per acre, and their own rental mechanism to show at what point does corn outcompete soybeans. We've done the same for cotton compared to corn as well. We've got a lot of decision tools out there, the enterprise budget, net return comparison tables I've showed you, various cash flow, ARC PLC estimates, as well as a marketing guide. I'd like to thank all the county agents for their willingness to get these out to stakeholders. One note on ARC PLC, you made that ARC PLC for 2019 and 2020, effective for the 2021 crop year. There is an election change. You can switch annually now. So by March 15th, you have to make the election and enroll, sign your contract for ARC or PLC for 2021. I've put the projected payment rates for the PLC program up. Rice, seed, cotton, and wheat for 2020 are expected to garner a PLC payment. Corn, sorghum, and soybeans do not, and that's based on the appreciation in their market price. We've got some tools out there to help you consider maybe switching from ARC to PLC for different commodities. Here's just an overview of the coverage type, payment caps, the interrelationship it has with crop insurance. But what Mr. Brian Hilbin and I have done is we've broken this decision down, and we've identified targets for the 2021 crop year of where those ARC payments would maybe be. This is about a 5-page report. We've gone through some of the math behind those numbers. This was sent out to the county agents. Again, with any of this stuff, if you have any questions, please contact me directly. I'd be happy to send you a spreadsheet or have a Zoom call with you. We've done our crop tools for 2020 and 21, evaluating ARC or PLC on a parish-by-parish level, and that's available for download. Again, you can get those tools from your county agent or email me directly. We do monthly market updates and a quarterly ad policy newsletter. I'd like to thank everyone that subscribed. We're almost at 370 individuals, and it's something I enjoy doing, and it allows me to, I guess, speak so off the cuff, if you will, with these market outlook presentations that we do. My contact information, if you'd like to call or email, I'd be happy to talk more about this in as much detail as you'd like. Office, email. Email is the best way to get in contact with me. Reach out to Justin. He can pass along or relay your message to me. But I can't thank these research boards enough for the support that they've not only given the department, but they've given my research and extension program for rice, cotton, soybeans, and feed grains. I'd like to thank the Rice Research Board, Cotton Incorporated, the Louisiana Soybean and Grain Research Promotion Board, Farm Bureau, and the Louisiana Cotton and Grain Association. Thank you very much.